All right, we're getting some traffic here. Hi, Serena. How you doing, Camden?
Hi.
Good. How about yourself?
You ever hear of Camden, New Jersey?
Yes, my roommate just recently told me about it.
There you go. It's a lovely city if you want to move to a nice place. All right, looks like we have a pretty good turnout here. Maybe wait another moment or so. We'll get into chapter 2 and let Wiley guide us along. This is an accelerated class, as you all know. We're going to be doing a chapter a day or 2 chapters a week in order to keep up with the curriculum. So it gets a bit daunting, to say the least. So let's get started here with a PowerPoint presentation. Let me share. Share. Okay. Chapter 2, we're going to start looking at a little bit of the financial statements, a little bit of analyses we can do. And let's see how it goes, okay? Wiley, the way they present these slides, they want to talk about the learning objectives. We're going to learn about what's called the classified balance sheet. We're going to look at a few financial ratios to measure a company's profitability and worthiness. And we'll talk about some reporting concepts, okay? So here we go. Classified balance sheet. A balance sheet is a snapshot in time, and that is a very important thing to understand. Sorry about that interruption. The balance sheet is a snapshot in time. It is showing you how much cash you have at a certain point in time. It's telling you what your accounts receivable are. It is just that, a snapshot in time. It is an expression of your accounting equation, which is assets equal liabilities plus equity. So on the asset side, on a classified balance sheet, we're going to have current assets, and then the long-term assets like investments, property and equipment, and then the intangibles. So that's what they mean by a classified balance sheet. They're going to break out current assets and a couple of other categories. Same thing for liabilities. They're going to break out what's called current liabilities from the long term. And then, of course, the stockholders' equity. Assets equals liabilities plus stockholders' equity. And let's take a look at the balance sheet for this company. Assets, they're listing on this page here. You can see they have cash of $6,600 and debt, short-term debt investments of $2, et cetera, et cetera. Accounts receivable, notes receivable, inventory, supplies, excuse me, and prepaid insurance are all considered current assets. What do we mean by a current asset? A current asset is one that will be consumed within a year or the business cycle of the organization. In other words, we expect our cash to be collected within a year, within one fiscal year, right? Accounts receivable, everything is going to be turned over per year. Long-term investments are things like stock investment, where you're going to hold the stock for a long time. Investments in real estate, that would be a long-term investment. And then you have property, plant, and equipment. Land, equipment, less the depreciation. Those would also be long-term debt, long-term assets. And then intangible assets, assets that you can't see, you can't hold them, but they're there in the form of intellectual property, patents and trademarks and things like that. So classified balance sheet breaks out those current assets. Look at the current liability side of this thing. Current liabilities. Notes payable, that's the long-term portion of the note. Accounts payable, unearned sales revenue, salaries and wages. Those are all, I misstated on the notes, that's current. These are all your current liabilities. It means that you're going to settle them within a year, probably 30 days, actually. Okay. So current assets, current liabilities. Look at the long-term liabilities. Mortgages are long-term. Notice you see notes payable a second time for $1,300. It's also on the first of the current liabilities. That's because the $11,000 number next to notes payable, that's the amount of a note that's due within the next year. The amount of the note that's not due for a year is the 1,300. So it looks to me like they borrowed money in the amount of about $12,300, and they're paying it back on a basis of 11,000 a year. Okay, so that's a quick look at what's called a classified balance sheet. And notice what I said. Your total assets are 61,400. Therefore, your total liabilities of 27,350 plus 34,050 should equal the 61,400. Nature of current assets. Well, this is what I was just saying. You expect to convert the asset to cash or use it up within a year or the operating cycle, whichever is appropriate. Cash, inventories, those are all current assets. The operating cycle is the average time it takes from the purchase of inventory to the sale and collection of goods. An example of an operating cycle would be a farming type company. Kellogg's Corn Flakes. Their fiscal year is set up from planting season until harvest, until they get it to market. That would be an example of an operating cycle for a specific type of business. And there again, they're showing you a presentation here. Southwest Airlines. These numbers are in millions. Wow. That means that Southwest Airlines has $1,680,000,000 worth of cash. So they got a ton of cash, it sounds like, huh? And then they have short-term investments, accounts receivable, inventory, prepaid expenses, which we'll talk about in a little bit. Total current assets, $4,498,000,000. Current assets are listed in terms of liquidity. They're always listed in terms of liquidity. By liquidity, I mean the ease in which it can be turned into cash. Now, cash itself is very, very liquid. It is liquidity by definition. A short-term investment, you can sell that in 10 seconds. You click on your computer and say sell, you sold it. You call your broker, tell them to sell it, you got rid of it. Accounts receivable, that represents the dollars that your customers owe you at that point in time. So at that point, Southwestern Airlines customers owed them $546 million. Okay, accounts receivable. You expect to get your accounts receivable in 30 days, 60 days maybe at the most as a general rule. But if you really needed cash quickly, Southwest Airlines can go to a bank and say, look, I have $546 million worth of receivables that is going to get paid over the next 3 months or so. How much will you give them for me now? And someone might say, I'll give you 400 million for them right now. And Southwest might take it. The point is, accounts receivable, very liquid, inventory, a little less so. Review question. Cash and other resources that are expected to be realized in cash or sold within 1 year are called, oh, I skipped on it. Current assets, very definition of current assets. Let's talk about long-term assets. You buy stock in another company and you expect to hold that stock for a long time. You bought that stock because you want to collect dividends over some time, or you really think there's a chance for capital gains, stock going up in price. That's an example of a long-term investment, and that would be on the books as such. Long-term assets also include land, buildings, equipment, vehicles, anything of a big ticket item that you're going to use in your business and get benefits from. And of course, long-term notes receivable. And that's how you present it on the balance sheet. You're going to have a line called long-term notes, long-term investments, non-marketable investments, 5183. A non-marketable investment is one that's difficult to sell reasonably quick. You might have to go to some special market to do it. You might have to go to the over-the-counter market. But it just means it's a little more difficult to sell than a marketable security. The nature of property, plant, and equipment. These are assets with long useful lives, and they're used in the operation. We assume you're still using them. If you're not using them anymore, you have to write them off and take an appropriate loss. But we're assuming that we're still using these vehicles. We're still using these trucks, these big stamping machines, whatever. They include land, buildings, equipment, vehicles, whatever you can think of. And they're depreciated. They are depreciated over the life of the asset. And that depreciation expense is allocated over a number of years. You could do it on basis perhaps of straight line depreciation or other calculations. Everything on your balance sheet when it comes to equipment or really anything is carried at the historical cost. You purchased a truck for $100,000. That $100,000 number is never going to change on your financial records. It's always going to be at 100. What you're going to be doing, though, is depreciating it through an account called accumulated depreciation. And we'll talk about that in a little bit of more activity here. So let's take a look at this section of the classified. It's all about the classified balance sheet. Property, plant, and equipment. You can put a colon there. That's the header. Land and land improvements, 47 million. Buildings, 282 million, etc. You add those up. That total you see there, 2,297,838. That is exactly what they paid for those assets. It's exactly what they paid. If the value of those assets go way up, you cannot record an entry to recognize a gain on an increase in an asset. As long as the asset is doing what it's intended to do, it remains at that original cost. They've depreciated more than half of these assets. So the net book value, net property, plant, equipment, also called net book value, equals the 864,227. Let's have a little fun with intangible assets. They don't have physical substance. You can't see them. Goodwill, patents, copyrights, trademarks, trade names. Goodwill is what you paid in excess of the company's value. You wanted to buy my company, and we both agree the company's worth $1 million, fair value. But I'm not selling it to you for $1 million. I want $1.5 million. Well, you give me the $1.5 million. That extra 500,000 that you paid is a cost called goodwill that goes on the balance sheet. A patent that gives you the right to market your own invention. Copyrights are for publishers, writers, authors. Trademarks like the McDonald's arches, something like that. Trade names, Oreos, something you can't make a cookie similar to an Oreo and call it an Oreo. You're protected by the trade name. And sometimes they're called other assets. This, I think, is kind of interesting, this clip here. Walt Disney Company, big outfit, huh? We're back up in the billions. Look at all the intellectual property they have. They have franchise fees like crazy. They have FCC licenses, trademarks. These are all valuable assets they have. And some of them have to be amortized down to zero and others don't. Intangible assets. Whoop, did I just give us the answer? Patents and copyrights are intangible assets, okay? Intangible. You can't see them, you can't feel them. You know they're there. Okay. I looked at this before the class. Maybe you can grab a pencil. You guys have a pad and pencil? Why don't you try to put this balance sheet together? I'll help you with it. I'll use you as an example, Susie.
Okay.
Okay, Susie comes to the meetings. Okay, what do they want us to do? They recently revised, prepare the asset section. Well, we know we have to list the assets in order of liquidity, right?
Yes.
So which one is the most liquid?
Cash. Always cash.
Always cash. Cash, then I would put receivables, maybe inventory, prepaid.
Prepaid insurance. Yeah.
Yeah, so see how they laid out that first part there?
Yeah.
What do they have in terms of long-term investments? They just have these debt investments and some trademarks. So that's a pretty simple look at putting a balance sheet together, huh? You start with the current assets and you sort them in order of liquidity.
Liquidity. So you can use them in less than 1 year.
Right, easy to turn into cash. You put them down in the order of how easy it would be to turn them into cash. Accounts receivable, we know we're going to get paid probably in 35, 50 days. Inventory, well, that's going to take longer because we have to sell it first before it goes into accounts payable. And prepaid insurance, there's really not much liquidity there at all. So that's a brief look at the assets section. Let's talk about current liabilities. These are obligations that are going to come due within a year. And the best examples are accounts payable. When you see accounts payable, that is always current. Accounts payable by definition are current liabilities. Salaries and wages payable, note payable, the short-term portion of it, interest, income taxes. These are all short-term debts.
Yeah.
So let's take a
They're
look.
usually net 15 or net 30.
Yeah,
accounts
yeah,
payable.
exactly.
Yeah.
Yeah, your receivables are probably net 30. That doesn't mean you're going to get paid in 30 days, but you hope to get paid in 30 days. You certainly get paid within a year. Look at the balance sheet section here. We start with accounts payable, which is very liquid. We know that's going to take cash right away. Short-term debt is going to take cash right away. And then we have the accrued compensation. This would be vacation pay, holiday pay. It could be 401k benefits or something. And then the accrued expenses, this would be your salaries and wages. And your income taxes, by definition, are short-term. I don't think I've ever heard of long-term income taxes payable. The government doesn't let you go more than a year without paying your income taxes. Believe me, I know that from hard living. Nature of the long-term liabilities. The long-term liabilities. We're going to be paying year after year. A bond, maybe. Maybe we borrowed money for 30 years. We bought a 30-year bond. That means that we received $100,000, say, today. And over the next 30 years, that $100,000 is going to sit there as a bond payable. And then at the end of 30 years, we pay back the $100,000. In the meantime, of course, we're paying interest. So bonds payable can be long-term, notes, leases, pension plans. And here's a presentation of the long-term liabilities. Bonds payable, deferred income taxes, and other long-term liabilities. Which of the following is not a long-term liability? Which is not a long-term liability? Bonds are typically long-term. Mortgages are probably long-term. I'm guessing, I see the word current. Current maturities are not long-term. Okay, we talked about assets on the balance sheet, on the classified balance sheet. We talked about liabilities on the classified balance sheet. Assets equal liabilities plus equity. So let's talk now about the equity section. And in our book, in our course, we are pretty much like Nordstrom's. We're pretty much a department store in the types of problems you're going to be doing. And a big store like Nordstrom's, when they went in business, they sold stock to the public. They prepared what's called a prospectus, and they drummed up some publicity. And they said on January 1st, 1960, we're offering this $1 par value stock to the public. That number comes in to your balance sheet as part of equity. Then another part of equity is retained earnings. Retained earnings just means just what it says. It's a part of equity. It's where a company takes its income every month, zeroes it out, and moves it to equity via the component called retained earnings. Another way to explain it, you start a business on January 1st, 2010, say. Started a business January 1st, 2010. By definition, you had no retained earnings because you had no profit yet. At the end of the year, you earned a profit of $10,000. Now your equity has gone up by that profit and it goes into retained earnings. The next year, you earned a profit of 40. Now your retained earnings have gone up to 50. So that's why it's called retained earnings. You're retaining the earnings from the whole history of the company. The only thing that's going to reduce retained earnings would be if you gave out dividends. Balance sheet classifications. Let me see what they're talking about. Match each of the current assets. Okay, I guess they want us to look at this. They gave us the answers already. Match each account to its proper classification. If the item would not appear on a balance sheet, use not applicable. So salaries and wages payable, we should know now those are current liabilities. Investment in real estate, almost by definition, is long-term. You don't buy too many properties and turn them over within a year. Unearned service revenue. I'm chuckling because they didn't even explain what this is to you yet. They're showing it to you. Unearned service revenue, current liabilities. Unearned revenue is kind of interesting. I'm a big sports fan, as you may or may not know. I send my check to Dodgers for season tickets. I send them in January. Cost me $12,000 for one good seat for the whole season, right? When they get my money, they increase cash and they increase an account called unearned service revenue or unearned ticket revenue. They cannot call it regular sales yet because they haven't provided baseball yet. When the season begins, then every month they reduce that liability. Unearned revenue is a liability that's not paid with cash. It's paid with the service. Okay. Match each account to its proper balance sheet classification. If it doesn't belong on the balance sheet, say so. Well, what goes on the balance sheet? Assets, liabilities, and equity. What does not go? Revenues and expenses. So let's see what we have here. Service revenue, that's not on the balance sheet. You see the word payable, you automatically know that's a liability. Goodwill is an asset. Depreciation expense is not going to be on your balance sheet. Retained earnings certainly will. That's part of stockholders' equity and equipment. Okay, so that's a brief look at the classified balance sheet, if you will. Now they're going to talk a little bit about some analysis we can do to see how the companies are doing. What's our profitability? What's our liquidity, our solvency? Are we making money? Should we go out of business? Should we expand? We're going to do some ratio analysis. We're going to express relationships among different items in the financial statements. Typical ratio analysis is going to take something from the balance sheet and divide it or multiply it or add it to something from the income statement to come up with a meaningful way to express what's going on. So the ratio is just dividing. It's just the mathematical relationship between one number and over. A single ratio is what we're talking about. Ratio analysis. Let's see what they're talking about here. Measure the income or operating success of a company for a given bit of time. We can take, for example, the net income and divide it by the sales, and that's going to give us a percentage. So if the net income was, say, $10,000 and the sales were $50,000, That's a 20% margin. That sounds pretty darn good as a starter.
Yeah.
20% would be amazing. Liquidity, here we're going to look at our cash situation. We're going to look at current liabilities, current assets, and then different solvency tests. So let's see what Wiley throws at us here. Look at our income statement. First time we're seeing an income statement for the year ended 16 and 17. They haven't updated these slides in a while, I guess. They're presenting side-by-side financial statements. And this is pretty typical. Well, let's see here. Our sales in 16 were 39.5. Our sales remained pretty much the same. Nothing much happened there. We had cost of goods sold, which is a big expense. That went down, which you would expect if you're selling a little bit less. But look at our total expenses. They pretty much stayed the same. So we had a little better year in 2017, not because we sold anything, but because we controlled our expenses a little bit better. Okay, let's have fun with this one. Earnings per share. Have you ever heard that expression? Earnings per share. You might be watching television, you're flipping the channels and you come to the news and you might happen on the guy talking about the stock market. He'll say, the earnings per share of Apple Corporation was announced today. It came to $3.08 a share. The expectation was $3 a share, so they beat the market. Earnings per share. It's your net income divided by the outstanding shares of stock.
Mm-hmm. So it's the monetary value.
Yeah, exactly right. It tells you how much per share a company earned. If a company earned $1 per share, that could be $1 they could give away in a dividend for you. So let's see what they're doing here. Here's our formula. The formula is earnings per share equal net income divided by the common shares outstanding. You first, though, have to remove any preferred dividends. And let me explain what a preferred stock is. A preferred stock gets paid a dividend before the common stock people. If you own a common stock, you cannot get a dividend unless all the preferred stock people are paid first. At your age, if you called a broker today and said, good morning, I'm Eugene here. I go to City College. I've got $100. I'd like to open up a brokerage account. That guy would grab your $100 for sure. And he would assume you're buying a common stock. Most stocks purchased are common stocks. Preferred stock, the only benefit of that is you might get the dividend or you might not, but you will get it if there are any dividends at all. So our formula is net income minus the preferred dividends divided by the outstanding shares, the average. The average outstanding number is going to be the number at the end of 1 year and then the amount at the end of the following year. So let's take a deep breath here. Let's look at 2017. The earnings were $12.28, and this company has no preferred dividends, so we don't have to worry about that. $12.28. We want to take the average of the shares outstanding at the beginning and at the end of the year. So that's what, 324 plus 311, that's 635. You divide that by 2 and you get a number. They're not showing you the number, but you get the average number there. It would be about 316 or so, I guess, huh? So the earnings per share, $12.28 divided by the average of the 324 and the 311 is $3.87 per share. This company generated $3.87 per share in 2017. Take a look at 2016. The number was much lower. The income was pretty much the same. Well, the income was a little significantly lower. The income was lower, and the amount of shares outstanding were a little bit higher. They only came up with 265. So if you're a shareholder, for example, as an older guy, I bought some stocks that pay pretty good dividends, and I'm not that worried about if the price of the stock goes way up or not. My concern is income. So I see one of my stocks that pay dividends, and I see that the earnings per share is $3.87. My first thought is, wow, that's almost $4 worth of dividend money. Now, do they have to pay dividends? No, they don't. Companies
No.
don't have to pay dividends ever. Even preferred dividends are not guaranteed. Okay. So that's our first metric, earnings per share. What were the earnings per share here? Why don't you pick up a pencil and see if you can come up with the answer here? Net income was so much. I'll let you look at the formula. Earnings per share equals net income divided by the weighted average. Here they do have preferred stock dividends. So the net income was 26,000. We have to subtract from that the 2,000 preferred stock and then divide it by the 6,000. Not too tough. Not too tough. Net income. Take out the 2,000 that has to go to the preferred. What that 2,000 means, if this company is going to give out dividends, 2,000 go first to the preferred people. Hopefully the company earned $4 a share. Well, $4 a share, maybe just $1 of that ends up with the preferred, and the common stock people walk away with a lot more money. Common stock is the kind of stock you want to buy. You want to be in stock mutual funds at your age. I'm not telling you how to invest, but basically that's what you'd probably be thinking about as you get out into the working world. Okay? Earnings per share. Using a classified balance sheet. Uh-oh, we're back to this again. The classified balance sheet. Why is it classified? Because it takes the current assets and isolates them. It isolates the property and equipment, the other assets. It's classified. Oops, come on. And there's the other side of the balance sheet. So let's just see if it balances, huh? I see 13,586 liabilities and equity. That better be true here for assets. 13,519. 13,519. Oh, come on now. So let's see what they have in store for us. Well, they want me to talk about liquidity. I think we got a pretty good idea what liquidity is. What you can turn into cash. What you can turn into cash. The ability to pay obligations right away. Now we're going to talk about something super important called working capital. Working capital. And what this is simply current assets minus current liabilities. Okay. So Best Buy has and we know that number is $1 billion, but they have 3,394 million in working capital. Their assets, their current assets were 10,516, and their current liabilities were 7,122. The difference is the 3,394. What that means is Best Buy is in a position where they can pay down every single penny of their short-term debt and still have $3 billion left over. So they're
This
pretty
basically shows the financial health of the company.
Exactly right. It shows the short-term health of the company mostly.
Yeah.
Short-term. And you're looking to invest in a company, working capital might be the first thing you look at. You know, if the ratio was only like 0.1 or something, well, that's not so good. The higher the ratio, the better. And we'll get to that in a second.
1.5 and higher.
Yeah, exactly. That's what we're going to be showing here, I think. So here, Expressing working capital in terms of dollars may not be helpful, especially when you're considering 2 or 3 different companies against each other. One company might have revenues of $1 billion, and the other one might only have a $500 million. The other one could have $4 billion. So talking dollars doesn't make too much sense comparing company to company. Let's talk about the ratio, what's called the current ratio. Current ratio. Here, we're going to take the current assets and we're not going to subtract the liabilities. We're going to divide by the liabilities. Okay? So, see what we have here. We have $10,516 in current assets divided by 7122. We get 1.48 to 1, about 1.5 to 1 ratio. What this means is for every dollar of current liabilities, Best Buy has $1.48 in current assets. So they too are fairly liquid. Another way to say it is if they paid off every dollar of current liabilities, they'd still have 4.8 million left over, or whatever that extrapolates to. Best Buy. Solvency. Solvency. That's a word we should know. It means the ability to pay your debts, the ability to pay interest as it comes due and repay the balance. You're solvent as long as you have a positive current ratio. Solvent. If the current ratio flipped, where the liabilities were more than the assets, technically you're insolvent and unable to pay your short-term bills. That's a big problem, okay? So this was a solvency ratio, like Zuzi pointed out. Solvency. Some users evaluate solvency using ratio of liabilities divided by equity. That's another one we can be learning. Let's look at this one. Debt to assets. Debt to assets. We're going to take the total liabilities, 9147. We're going to take the total liabilities of 9147 and divide it by the total equity, liabilities and equity. We take a peek here. Comes out to 66%. So it's been in the high 60s the last 3 years. This ratio means that every dollar, if every dollar of assets was financed by 66 cents of debt. Every asset they owned, they borrowed 66 cents at least to buy it. So that's a measure of how much into debt they're taking on. 66 cents, 66%. Is that too high? Is it too low? I don't know. It would depend on the company. It would depend on the industry. It would depend on the norms of a particular area. Come on, this thing doesn't want to. When debt is good. Debt is good, huh? Debt financing differs greatly across industries and companies. Here are some debt to asset ratios for selected companies. So I find this very interesting. Look at this. Google has very little debt. Very little debt. Nike has a little more. Microsoft, as you get into the bigger companies. Wow, General Motors, 74%. Well, that's probably because General Motors is such a big outfit and they're always buying big equipment, big robots and machines and metal and steel. And they don't want to chew up all their cash doing that. So they finance some of it and they're willing to finance 74%. So for every dollar of equipment that General Motors buys, it's going to cost them 74 cents in debt. The size of the debt depends, like I said, on the industry, on the type of company, what the norms are in a certain area. Evaluating cash flows. Oh, this one's fun. Evaluating cash flows. Cash flows simply means the amount of dollars you're receiving in minus the amount of dollars that go out the door. Obviously, you want to have positive cash flow. And you want it generated by operating, not by investing, not by financing. We talked a little bit about that in chapter 1. So here we're going to talk about free cash flow. This is going to be the amount of your operating cash flow that you can use for whatever you want. So let's see what we have here. We're going to have a formula that says free cash flow equals net cash provided by operating activities. And you would get that number right off your cash flow statement. We're going to subtract capital expenditures and we're going to subtract cash dividends. We're taking those out because those are things that we do want to take care of with the operating, and we want to see how much cash we have free after that. So let's see what we have here. MPC produced and sold 10,000 personal computers. It reported 100,000 in cash in operating activities. In order to maintain production, though, they had to invest 15,000 in equipment, and in order to attract investors, they agreed to pay 5,000 in dividends. Those items come off the top, free cash flow. That's money that the company can use for whatever purpose it wants. It could turn the company cafeteria into a bowling alley if they want. Put something frivolous if they wish. Here are some more ratio analyses. They're giving us some numbers here. Whoa, look at all these numbers, huh? Well, they're giving us the balance sheet first, then they're giving us net income. Uh-oh, we're gonna have to do some work. Are you ready? Are you ready? Let's see here. Earnings per share. Why don't you write down the formula? What's the formula? Earnings per share. It's earnings minus preferred dividends. Earnings minus preferred dividends. So what was their net income? $100,000, right? What were the preferreds? 10,000. So that's $90,000. Your numerator is going to be 90,000. What were the beginning and ending shares? Beginning was 60, the ending was 120. 60 plus 20, 60 and 12 is 180. I'm guessing 90,000. I'm guessing that the answer is 1-to-1. Did we get that? Were you able to follow that, Kelly, for example? Okay. Ozone's competitor, Frost, had $2 per share. So it's just a matter of working with the formulas a little bit. And it's not a matter of memorizing them. It's a matter of just understanding the information you're trying to extract. Well, if I want to find out the earnings per share, per means divide, right? Per means divide, earnings divided by outstanding shares. Let's see what else they got. They want us to do the current ratio. Take a second to compute the current ratio. Current ratio for 2022 and the current ratio for 2021. Did you get a number? I'll pick on Kelly. Did you get a number, Kelly?
No, I don't. It's just a little fast for me.
Okay, that's okay. That's fine. You hang in there.
And I'm taking notes.
That's okay. I talk quickly. I'm from back in New Jersey.
I know. And I'm following you as much as I can, as well as I can. So thank you for pointing that out and asking.
And this will be put up on video for you too, right?
Yes, thankfully.
Yeah.
Thank you.
Okay, well, let's go through it together then, Kelly. What were your current assets on 2022?
88,000.
And what were the current liabilities?
40,000.
What's 88 divided by 40? That's your answer.
Oh, okay.
That's all there is to it.
Oh,
the other one, current assets were 6,800. Current liabilities, you divide those out.
Divide that. Okay. Thank you.
Did you get answers, Susie?
Oh, the first was 2.2.
Okay, I hope everybody got 2.2. And what was it for the second one?
I'm not there. I'm doing double work here.
Anybody got the second one? Let me know.
I can't see. Oh,
Let me show you the numbers again.
yeah.
6,800 divided by 38, I guess, huh? And that's all there is to it.
1.78.
Okay, maybe you can jot those numbers down if
1.79.
you like. The current ratio. We just did the current ratio, didn't we?
Yeah, that was the.
Yeah, we just did this one. Okay. The debt, they want us to do the debt to assets. That's easy. Debt, I don't want to say easy, I shouldn't use that word. Debt to assets. What were the total assets of this company? 400,000. What was the total debt?
Total.
Total liabilities are how much?
Oh, it's there.
Yeah.
120.
So it's just 120 over 40. 12
Okay.
over 40.
Right.
Do the second year. Your total liabilities are 150.
150 over 341.
That's all there is to it. Not too tough, guys.
That's easy. Thank you for
But
pointing that.
understand what this is telling us, okay?
Yeah.
You know, what were the two ratios you came up with, please, Susie? For debt to ratio?
400. Total liabilities.
120 divided by 400.
Yes.
120 divided by 400.
So 0.3.
Okay, so 30%.
And the other one is 150 over 341, and it's 0.44. So,
Yeah, so they really borrowed a lot of money in 2021. And then the next year looks like they got a little bit more control over it.
so would you invest?
Well, I'd have to see more. I'd have to see what product they're making, you know. I would need a little, or I just ask my brother-in-law because he's pretty smart. Anyway, look at the free cash flow. Remember free cash flow? This one we'll look at it together here because this one's is a little more difficult. Free cash flow. We want to take the operating cash flows, not the financing cash flows, not the investing, but just the operating cash flows. And let's subtract out what we're stuck on spending for dividends and property, plant, and equipment. We subtract those numbers out and we come up with 50,000. That represents money they can do whatever they want with. That's money that they've earned. They can put it into the bank and forget about it, let it grow some interest. They can use it to pay more dividends if they want. They can use it to invest in another company or expand the business. And then finally, the third objective, reporting concepts. So this should be very exciting. Let's see what they got here. Reporting concepts. Did we talk about GAAP in chapter 1?
Just very briefly. It wasn't the subject.
Okay. GAAP. Know this acronym like your own name. Generally accepted accounting principles. These are the rules of accounting as promulgated by the American Institute of Certified Public Accountants. They're the ones who set up the rules. When do we record revenue? When do we record an expense? What's the appropriate handling for this item or this area? GAAP. Everything you do has to be GAAP, or your financial statements will not be blessed by the auditors. If you don't have audited statements, you're never going to be able to borrow money. You're never going to be able to invest, get people to invest. You need these audited statements done by GAAP. And this is set up by the Securities and Exchange Commission. You ever hear of the SEC? The good old SEC, Securities and Exchange Commission. If you want to get your stock listed on the New York Stock Exchange or even the over-the-counter, you have to prepare quite a lot of information. You have to prepare financial statements in great detail. not just the income statement, equity statement, and balance sheet. You got to provide all kinds of information of what your company does, what it hopes to do, how you hope to do it. And you have to be pretty clear to the SEC that you're worthy of being listed. Once
So
you're
they
listed,
overview the whole market.
oh, the whole company, absolutely. And then when you're put on the stock exchange, the market will, the price of the stock will set itself. As soon as you put it on the stock exchange, whoosh, that's your initial public offering. And then the stock is worth $20 a share, 30, whatever the market says it's worth. Okay. And that stock will stay there as long as they don't pull any shenanigans, that they're doing things correctly. Or if the price of the stock falls below a certain level, now I might be wrong on this. I don't think if a stock goes below $10 a share on the New York Stock Exchange, it gets delisted. It means they won't list it anymore.
Mhm.
That's a terrible thing. If that happens, it's the worst signal to the world. Poor General Electric is in such financial peril. It's been in a nosedive for years now. Their stock started to fall down to that level, and they came up with what's called a reverse stock split, which artificially boosted up the price without doing anything for anybody. So on the stock exchange, you have to have a minimum threshold. Here's another acronym, please. FASB, Financial Accounting Standards Board. Those are the CPAs who put the rules together. Generally accepted accounting principles are a set of standards and rules that are recognized as a general guide for financial reporting. Okay? Set of the rules. Qualities of useful information. FASB says useful information. It's one thing to give information out, but it's got to be useful. It's got to be relevant and faithfully represented. In other words, no fraud. It has to be material. In other words, the auditors are looking at your financial statements, and you have a company and your profit is $20 million, and the auditors find a $2,000 mistake. They'll say for $2,000, we'll let you go. It's not material. That's all they're talking about there. An item is material when its size makes it likely to influence the decision of an investor or creditor. I mean, a real big mistake would require you to redo your financials. You would have to confess to the world that you screwed up. It'd be a terrible thing. Relevance means that it has some meaning. You can use it to do something. This information is relevant, and it has a certain predictive value. Using this relevant information, we can predict a little bit, hopefully into the future, and make some wise decisions now. Information must be complete, neutral, not biased toward one position or another, and hopefully free from error. If you're an auditor and you're auditing Microsoft and you own Microsoft stock in big numbers, that could be a conflict of interest. The auditor can take the audit and make it look like Microsoft is much better than it is. That's the neutrality we're trying to understand. Oh boy, these grids can put me to sleep sometimes. Enhancing qualities of useful information. Comparability. When you're using GAAP, you can compare the statements. If one company's not using GAAP, you can't compare them. You don't know what they're doing. And as we said, the information's got to be verifiable. It's got to be understandable. Consistency, you're using the same principles. And it also has to be timely. What good is it if someone comes to you and says, you know something, I think an investment in Coca-Cola would be great. And you say, yeah, why didn't you tell me a week ago when everybody else knew that? And the stock has tripled since then. It's too late. It's not timely. Come on. I could probably skip this. they're assuming that we can measure everything in money, that we can measure everything in a currency of some kind. And the economic entity assumption, it just means that any business can be analyzed. I think I'm going to go through these a little more. Oh, God. Here's a word you have never, ever used in your life. Periodicity. Don't make any notes on this stuff. It just means that a business can be divided into a month and analyzed that way. Going concern is an accounting term meaning that a business is considered to be permanent. It goes on. It's like a shark. It just goes on and on and on. But you can divide it up into a month to analyze. Now, this is kind of important here, historical cost. Everything on your balance sheet is going to be at the historical cost. You're never, never, never going to raise anything. Fair value indicates assets, liabilities reported at fair value. That's an exception. And the way they're presenting it here, I don't particularly like. And companies are responsible for full disclosure. You tell the world what's going on. Oh, Jesus. These are horrible. The following items guide. Okay, well, these are the different, what you see here are called some of the rules of GAAP, relevance, faithful rep. I don't think you need to study these in great detail, but read through them so that they at least make sense at the time you're studying. And if it pops up on a test, you know, if they come up and they say periodicity, what's periodicity? Well, period. It just means you can break the business down into a period of a month to analyze it. Yeah, these terms can be kind of troubling on tests. They come up in the form of true, false questions. Financial accounting concepts. Okay, so they're giving you some quick definitions here. So this should be quite useful. Okay. What is the primary criterion by which accounting information can be judged? I actually was stuck on this one and I had to think about it. They're saying accounting information is good if it's useful for decision making. You might make the wrong decision. You might make a decision to buy a fax machine company now, but you had the right information in front of you. You just didn't use it correctly. Here, this is international. We're not going to get into international. The end. Ta-da! Boy, that was a pretty busy hour, wasn't it?
Yeah.
Yeah. Any comments, anybody? Any questions?
I'm thrilled that you have this for us to keep because it's a lot of information. And
Yes, it is.
And it's excellent, you know, so I'm glad that you're also mentioning that this isn't important. This really isn't going to be, you're not saying it's not going to be on the test, but it's not important.
Yeah, what's important are those ratios and understanding what the balance sheet looks like. And like I said, Wiley is a new publisher. This is the first time I'm working with their slides. And it's so different than McGraw-Hill, which I'm used to. So that's a little bit of a constraint on my end.
Why did they change?
Well, long story short, we hired 2 full-time professors, and they're both advocates for Wiley.
Okay.
And they got a good price on it, and they think Wiley is superior.
Mhm.
I've not seen that yet, only because I just started with them, you know.
Right. But you might see it later, but not now. Okay.
Yeah, hopefully I'll see why they're so great. I'm not in love with their slides. I think these slides were just dumped together. And the idea is that each teacher sets it up the way they want. And that's what I'll probably be doing in the future.
So
okay?
these 2 professors are accounting, obviously. 2 new
Yeah,
professors.
Professor Woyak, yeah. Professor Laura Woyak and Professor Ben Reyes. They both
I had
love
Laura. Yeah.
Oh, okay. She's my old friend.
Oh, she's like a fast speed train.
If you think I'm a goofball, she's pretty a goofball too, right?
Yes.
That's what makes it funner, though. It makes it funner that way.
No, she's very nice. All right, one more comment. Hey, Camden, what do you got to say for yourself?
I had one question regarding participation in these sessions. How did you want us to do that? Do we take a picture?
Oh, for the,
Of
for the,
yourself.
for the summaries?
Yeah, yeah, just like to have proof that we're like in these Zoom sessions.
You mean in this session here?
Yes, correct, for the extra
Oh, no,
credit.
no, you get credit automatically. This,
Okay, we don't have to like personally do anything.
no,
Okay.
not at all. We know you're here.
Okay.
We know when you're here. We know when you're not. We know where you are 24/7, Karen. You can't get away from us.
Sounds good.
Well, thank
All
you very
right.
much.
With that in mind, I'm going to close our session exactly on the 1 hour point. Okay.
Wonderful.
Thank
Yes.
you.
Back to
Hey,
work.
bye-bye, Susie,
Thank you very
everybody.
much. See you
Thank you.
tomorrow, probably. Bye.
You know where to find me.
Yes.
Bye.
Bye.